Hi CA students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decisions. Practical question 3. So a company is considering project X and Y with following information. Project X expected NPV and standard deviation. Project Y same expected NPV and standard deviation. The requirements of questions are: which project will you recommend based on the above data? Based on the above data, there are two things. In perspective of risk, if we consider project X is less riskier and project Y is more riskier. In perspective of wealth maximization or NPV, project Y gives more returns. So if risk is the base, then project X should be considered because less riskier. If wealth maximization or NPV is the base, more returns is the base, then project Y is suggested. In ICAI solution, they have taken on the basis of standard deviation, project X can be chosen because it is less riskier than project Y having higher standard deviation. They stopped there, but we can write if wealth maximization is the base, then project Y can be chosen. Second requirement: explain whether your opinion will change if you use coefficient of variation as a measure of risk. So this is an opt solution because as we have previously discussed in our illustrations, coefficient of variation is per rupee standard deviation per rupee risk on a project. So here also, since the standard deviation is 90,000 for 1,22,000, what is for 1 rupee? So 90,000 divided by 122, we will get around 0.738. So this is for 1 rupee of expected NPV, the risk is 0.738. In case of project Y, 120 divided by 225 will get around 0.533. So comparing this, project X seems to be riskier, correct? In the previous case, when the normal comparison, we thought project X is less riskier, but after considering coefficient of variation per rupee risk, if you consider project X is riskier and project Y is less riskier. ICAI solution also same, coefficient of variation for X, standard deviation divided by expected net present value will get 0.738, and then for Y 0.533. On the basis of coefficient of variation, project X appears to be riskier and hence project Y is accepted. Which measure is more appropriate in the situation and why? So as per ICAI, they have taken wealth maximization as the base and they have considered that as the base, and then they have selected project Y is suitable. That is correct. So I'll read the answer once. However, the NPV method in such conflicting situation is best because NPV method is in compatibility of the objective of wealth maximization in terms of time value. This is obviously correct, but I have a suggestion that coefficient of variation is also a best measure. In that case also we will accept project Y because in coefficient of variation I'll get to know per rupee risk, right? So in that case, instead of if my investment is 5 lakh and project X is giving the return of 1,22,000 and project Y is giving the return of 2,25,000, wherein my per rupee risk also is lesser, I would obviously invest in project Y. If I want more, like if I want the wealth maximization as the priority, still since the risk is lesser, I can reinvest in the project again. So these are various point of views, but we should obviously go with the ICAI solution, wherein they have taken NPV method is compatible for objective of wealth maximization. Thank you.